Let's assume an investor purchased a multifamily property for $1 million. And on this property, they used the loan, assume the loan to value was 70%. So the debt on this property is 70% of the purchase price. Actually, let's make this 75%. So it mimics the example we looked at before. So the out-of-pocket cost, and this is a very simplified example. So that investor, we put in $250,000 of their own money. What's their annual loan payment? First, let's take a look at the debt. Debt amount is $750,000. Interest rate in today's market, let's assume, I'm going to say 6.4%. Amortization period, let's say 30 years. So that's 30 times 12, 360 months. The annual loan payment, we use the PMT formula. Our rate is 6.4% divided by 12, because that's the annual rate. Number of period is 360, or we can do 30 years times 12, either one. And our present value, that's the loan amount. That's negative loan amount. And this is the monthly payment. So our annual debt payment multiplied by 12. That investor is paying a total of $56,295 each year in debt service. When we're thinking about leverage, the true definition is comparing the cap rate to the loan constant. And the loan constant is the annual debt service divided by the total loan amount. In this example, the loan constant is 7.51%. If the cap rate, which is your theoretical return on investment, is greater than the loan constant, the cost of borrowing, then that's considered positive leverage. If the cost of borrowing is higher than the cap rate, then that's considered negative leverage. Let's take a look at the cap rate for this property. We know we purchased it for $1 million. Let me look at property level. Let's say this property, the effective gross income, let's say $100,000. For expenses, let's assume a Class C property. We're going to assume 50% expenses. So our total expenses is 50% of the revenue the property is generating is $50,000. A net operating income, or NOI, is the effective gross income minus the expenses, so it's $50,000. That's NOI. We have our purchase price and we have our net operating income, so we can calculate what that property cap rate is. Your cap rate is just the net operating income divided by the purchase price or the value of that property. This is in percent. The cap rate based on that purchase price and the net operating income is 5%. What this is telling us is that if we paid all cash for this property and our cash flow was $50,000, our return on our investment would be 5%. When comparing leverage, let's start with using the true definition of leverage. We're going to say use the if formula, if the cap rate, so our return on investment, is greater than the loan constant, let's call this positive leverage because our return is greater than our cost of capital. But if it's not, then we'll call this negative leverage. This is a very simplified example. A lot of times in the multifamily space, investors would just use the interest rate. They will compare the interest rate to the cap rate to determine what the leverage is. But the true definition of leverage is comparing the cap rate to the loan constant. And the loan constant is the annual debt service divided by the total loan amount. In this example, we're saying that if the cap rate is greater than the loan constant, it's positive leverage. If it's not, then we're going to call it negative leverage. Let's put formatting on here. If that cell contains negative leverage, turn it red. However, if it contains positive leverage, I'm just going to duplicate this, change this rule, turn it green. What is this telling us? If we look at this practical example, say this is a deal that you're looking at. You purchased it for $1 million. You got a loan with an LTV of 75%. The lender is bringing in $750,000. You put in $250,000 of your own money into this deal. The lender gives you an interest rate of 6.4%. With a basic definition, if we compare that interest rate to the cap rate, we can see that the cost of borrowing is actually higher than our projected returns if we paid all cash for that property. But the true definition of leverage is using that loan constant, because that loan constant can be impacted by the amortization length as well as the interest rate. If the cap rate is higher than the loan constant, then that's positive leverage. But if the cap rate is lower than the loan constant, then it's considered negative leverage. The question you might be asking is, why would an investor pay for a property with negative leverage? Well, let's take a look. What if in year one, that property is only generating a net operating income of $50,000? But through your comp analysis, speaking to your property manager, you realize there's potential in this deal through a value add strategy. By doing a value add strategy, by year three, let's say stabilization, you're able to increase that effective gross income to $150,000. What does that look like? If you increase that effective gross income to $150,000, cut your expenses, let's say we're becoming more efficient, let's cut this down to 43%. So now we increase the effective gross income from $100,000 to $150,000, and we reduce our expense ratio from 50% to 43%. Now there's an increase in our net operating income. And if you look at that property cap rate, it's now 8.55%. Comparing that to the loan constant, you have positive leverage. I misspelled this. It should be an I. Now we have positive leverage. That explains why sometimes you might look at a deal, comparing the year one cap rate to the loan constant or the interest rate is giving you a negative leverage. But with a business plan, you can increase the NOI over time through increasing the revenue or decreasing the expenses and convert that negative leverage into a positive leverage. What if you paid all cash for that property? So the purchase price is $1 million. Let's assume the same revenue. Now you're paying all cash for the property. There's no debt on that property. Property level, everything stays the same. I'm just going to copy this down. The same thing applies here. If you paid all cash for this property without using a loan, now your net operating income becomes your cash flow because you don't have any debt service, so you're not paying any debt on that property. If you look at the cap rate on this property, it should be similar. The cap rate, which in this case is also your unlevered cash on cash, is 8.55%. So in order to determine if putting a debt on this property would help or negatively impact your returns, you would have to compare this cap rate to whatever interest rate that lender is offering. That lender is offering an interest rate of 6.4%, like we have in this initial example. Then the cost of borrowing is lower than your projected return on this property, which is 8.55%. That would be considered positive leverage. So when you're thinking about leverage, you're trying to assess, is putting a debt on this property going to help or negative impact my returns? Sometimes you might go into a deal with negative leverage, but by executing the business plan through increasing the revenue, decreasing expenses, which increases your overall net operating income, you can convert that negative leverage into positive leverage, as we've seen in this example. Leverage is a powerful tool in multifamily investing, but it's not a guaranteed shortcut to success. The key is to analyze every deal carefully, understand the relationship between cap rates and interest rates, and plan ahead for economy shifts.